Hello and welcome. You're watching KYC, which is Know Your Company. It's a show designed to give the regular investor powerful, actionable insights into fundamentals of single NSE listed companies every day. So we're going to bring you today Aadhar Housing Finance. It's of course, as the name suggests, a housing financier. It's one of the largest private housing financiers in the small mid-cap kind of space. Has around 18,000 crore in terms of market cap, does mortgage-related loans and products. It also has a presence largely in 20 plus states. It gives loans for residential property purchase as well as construction. It also does home improvement and extension loans. Of course, all of this is secured and all of this is in the retail category. Quickly rolling forward, loans for commercial property and construction as well as acquisition. So it does those as well, but a smaller quantum, and it's largely focused on low-income housing. Sub 15 lakhs is the loan ticket size which they generally give out. Their average ticket size per customer is 10 lakh rupees. So really, really small in terms of loan size. 74% of its loans are to retail and retail home loans, and 26% is other mortgage loans, but again backed by housing and largely retail. Now, in terms of just the trajectory, in terms of scale, 21 states that it currently covers. It has branches across these 21 states, and the number of branches at the end of Q3 is 557. So it's a wide branch network that it has. Also growing at a healthy clip, that number. So something to look out for in terms of growth as well. But quickly on to parameters, and we discuss these every day, and depending on the type of company we break down parameters. But this one is a housing financier, NBFC, so these are the parameters we look at. We look at the income statement, how quickly that has grown, the balance sheet, how well and how adequate is its capital adequacy ratio, as well as what kind of growth clip does it have on the AUM. Operational metrics, this is key generally for housing financiers and NBFCs, because it determines, and we try to break down what the spread is, what the margin is, what the yields are like, and what's the kind of ROA that the company clocks. ROA is return on assets, and it's a measure of profitability. So how profitable and how consistently profitable is the company? That's something we look out for. Among others, we look at shareholding, street cred, street coverage, as well as valuations, all relevant metrics to look for when you're looking at a company and when you're analyzing it. Of course, over the next 20 odd minutes, we'll break this down as well as speak with management. We'll also talk a little bit about risks, because that's a key, right? When you're looking at any company from a bottom-up perspective, you want to look at what the risks also are. Let's quickly look at the income statement though, and let's pull that up and let's break it down. Your net interest income has gone up at 28% CAGR over the last 3 years. Provisions down 9%, very healthy, because despite a faster growth clip that the company is clocking, you've not seen provisions go up. In fact, it's come down. But mind you, 3 years back was a slightly higher base as well. Profit after tax growing at a very healthy 30% YOY. So you look at those two numbers and it starts to show it's quite stable in that sense. Both of those numbers, 28% on NII and 30% on profit after tax. So those are two metrics, clearly a thumbs up given the kind of growth clip that this one is growing at. Let's look at the balance sheet now. Let's break that one down. You look at AUM growth, extremely healthy. You're looking at a 19% kind of AUM CAGR over the 3 years and 9 months that we're looking at it from 14,000 or sub 15,000 crore. It's gone up to nearly 24,000 crore in just about 2 years and 9 months. So 2 years and 3 quarters. And likely that growth clip will sustain, but it's something that you'll want to ask and quiz management. But look at the borrowing number. Generally, when you're looking at a fast growing company, you'd want the borrowing number also to go up commensurately, and that's exactly what's happened. It's gone up from 8,000 or sub 8,900 crore to 15,000 crore, but it's done its IPO, it's listed. Capital adequacy, therefore, is extremely healthy and continues to remain so. Historically, this company has had a capital adequacy of anything between 35 to 45%, and that seems to continue even in the post-listing era of the company, and that's one key positive you'll want to look out for. And therefore, what this will typically do is a large part of the lending that they do is funded through equity. I'd want to understand, and we'll have the management again, whether that will continue or whether they will do more leverage and more borrowing, because that will add to the profitability metrics as well. So I'd want to look out for that one. The 19% AUM growth is significantly positive, and the CRAR, how does it evolve, is something I'll want to look at. When does the next equity raise actually come? Now, we're looking at operational metrics now, and balance sheet, just to kind of cap off the point, is a neutral, because I'd want to look at those couple of metrics as to how quickly or how much is the company willing to borrow, or will they have capital adequacy between 35 to 45% from a conservative standpoint, and therefore will not take on leverage. That's something I'll want to really quiz the management on. But let's look at yields now. Yields have largely been in the 13 to 14% kind of mark. That's the kind of yield number that we have. You look at the cost of borrowing. The cost of borrowing has gone up from 7% in FY22 to 8.1% in 9-month FY25. This is also because we've seen the rate cycle change, and therefore you've seen cost of borrowings go up. Spreads, though, have been extremely flat. You've seen the spread anything between 6 to 5.8%. The management has always guided that they'll continue to aspire for this kind of a spread, and spread won't decline meaningfully. Margins are at 9.2%, and we're not flagging that off simply because of what I described in the balance sheet. It's very, very large amount of equity, which is what is funding the balance sheet at this point. If that unwind were to happen just to give you clarity, 24,000 crore is the AUM. The borrowing number is just about 15,000 crore. So you've got 9,000 crore of equity, which is funding the AUM alone. Now, it's not very common for NBFCs or financial lenders to have that kind of a leverage ratio. It's very, very low, and therefore the risk is very, very low, but also it kind of keeps a lid with regard to returns, and therefore that's something I'd want to look at, and therefore that neutral rating there as well. But cost to income, this also has been fairly decent. The FY22 cost to income was 36.3%, 37.5% in FY24. In FY25, there's a correction here, 35.9% is the current cost to income ratio. So it's the lowest in the last 3 years, the cost to income, and I'd want to know whether that has scope to shrink further or not. Definitely a thumbs up on this metric. You look at ROAs last off, just to kind of cap it off. They've gone up from 3.2% to 4.3%. So ROAs have just gotten better as the years have gone by. Can ROAs hold up will also be the other question, but otherwise operational metrics largely positive in my mind. Let's talk about asset quality. Your NPA ratios, when you're looking at those, largely stable, right? Last at least 4 to 5 quarters, they've largely been range bound. Even your net NPA, largely range bound, anything between 0.9 to 1. And two things which stand out for me when you're looking at asset quality. One is your loan to value ratio. What does loan to value actually mean? It means that the loans that you're disbursing, right, as the ratio suggests, the loans that you're disbursing to the value of the asset, because it's a 100% secured loan, the value of the asset that you have. So say, for example, you have an asset of 100, you've disbursed a loan of only 59. That's what this indicates, and therefore looks very, very comfortable, because in case of a default, I mean, there may be individual loans with different LTVs, but largely with a 59% LTV, the book looks robust, because in case of a default, if you need to recover 59 from a 100 rupee asset, that's very easy to do. And that's what this essentially indicates. So you may want to look out for that as one of those. And second is, it's a 100% secured book. So your loan to value largely indicates the safety net that the company has to try and recover in case of defaults. And that's what gives me comfort to give this a big thumbs up, because it's a 100% secured book and your loan to value ratio is just about 59%. I want to also zoom in on the shareholding pattern. Now, while I've given this a thumbs up, the shareholding pattern, it's because 75% is promoter held. I'd be very curious to know whether the promoter is looking to dilute at any point in time. Mind you, it's a recently listed company, and therefore promoter holding of 75+% is not too common. And even where in NBFCs you have these large promoter holdings, you will somewhere start to see the promoter dilute, because eventually the RBI does want more and more free float holding, as they call it. I mean, in banks, of course, it's capped, but in NBFCs, there is no cap. But at the same time, you would want to try and understand as to whether the promoter holding is going to come off or not. And we will ask the promoters that when we speak with the management today. I want to also talk about street cred. I've given this a positive nonetheless, the shareholding. But let's talk about street cred. Now, this is one metric where the 3-month performance hasn't been great. But when you're looking at the 3-month performance on the Nifty mid cap and small cap, this one has sharply outperformed. And therefore, I'm very tempted to give this a thumbs up on this metric as well. 25% from listing. So those investors who have held on to the stock even or who got the stock in IPO, who have held on to the stock since the day of the listing, have made decent money. They've left money on the table for some of those investors, which is a positive. So all of those metrics point well in terms of the direction in which the stock is expected to be at. You're looking at street coverage. 7 analysts track the stock, and there are some marquee analysts here. There's a Citi, there's a Nomura, there's an Investec. Some of them have given it very, very strong upsides, but the average upside is 41% on this one. In a falling market, it's interesting whether this will start to see downgrades. Well, we've not yet seen it, but you want to keep your eye out on that. But a 41% upside as of now clearly warrants a thumbs up on this count as well. Last off, with regard to valuations, and it's not looking very, very expensive either. You look at an Aptus, you look at a Home First as well. I mean, I don't have the Bloomberg price to book on Home First, unfortunately, because there isn't enough coverage, but it trades at above 3 times price to book, largely. Home First Finance, Aptus Value, there's also an Avas. PNB Housing is one of those where there's a turnaround at play, but at the same time, that one, because of the turnaround and because of the risk, is valued at 1.1 times. Aadhar, for a 4+% ROA business, to value it at 2.3 times seems very, very fair in that sense. So valuations don't seem egregious in any fashion, and they seem okay. And therefore, you're seeing a 2.3 times price to book on this one. But that's broadly the picture with regard to the company. And just a couple of things I want to highlight here before we move on. Of course, there are risks that each company comes with when we invest. And while we have a 7.5, which is a record rating on our KYC, very little wrong that this one is doing at this point, basis the numbers that we are looking at. But I want to highlight a few risks. One, can the scale up of the business continue? That's one thing, and that's one risk that you'd want to bear in mind. There's rising competition in housing finance. You have, it's a decent margin product, it's a secured product, unsecured is facing headwinds, and therefore you might well see that there is plenty of competition pressure which is there. And any kind of asset quality deterioration may also be a bit of a dampener. Other risks, of course, we spoke about, could be promoter dilution. there is also one key piece which we've not spoken about, that self-employed is rising as a share of the business. I'd want to know whether self-employed will come with its set of risks and those risks are getting priced in separately, or is there enough comfort on the asset quality standpoint even from self-employed? So those are some questions that I'll want to ask and quiz Mr. Rishi Anand on. But let me quickly welcome him on board. He is with us. Thank you, Mr. Anand, for coming, speaking with us live this morning. Always good having an understanding housing from or housing finance from your perspective. So I want to first understand, and this is more focused on Aadhar housing, as you would have gathered if you're watching us. So I want to first understand what the growth clip is likely to be and what the levers for that growth clip are for the next maybe 2 to 3 years. From an investor standpoint, what should he expect from you?
First thing first, very good morning, Harsh.
Good morning.
It's a pleasure to interact with you and good to see you. Okay, so first you asked about the growth levers. Let me give you some indicative numbers, and we've always guided these numbers. I will stick to those numbers. AUM growth 22 to 24% as we head towards the financial year closing. Disbursement growth would be about 20 to 22%, which will ultimately tantamount to about 20%, 22% growth in profit after tax. How do we get this growth? What are the levers? There are multiple levers, right from multiple government initiatives which start from PMAY 2.0 interest subsidy scheme to Swami scheme that just got announced, Swami 2.0, tax benefit that has just come in up to 12 lakhs, which will enhance the loan amount by 3 to 4 lakh rupees for each individual. Then more importantly, the mortgage guarantee fund that has been announced pre-budget, which caters to the EWS LIG segment. So that's from the government initiative perspective. From Aadhar perspective, individually, we are looking at expanding our network. As you would remember, we've already added about 60 branches this financial year, and we will continue with this trend over the next 2 to 3 years. 60 to 75 branches will keep adding. In terms of states, we are already in all possible states. We are already in 21 states. So what we are currently doing is expanding our network into deeper locations, into small talukas and small district centers. That's what we are doing, Harsh.
Understood. And so what allows you or what gives you the comfort that as you grow deeper, there's not going to be any impact on asset quality?
Harsh, going deeper is a part of our overall strategy. See, what is happening is the larger cities, the top 100 cities of the country, because of inflation, because of rise in cost of construction, because of certain bit of competition, there are two things that are happening in larger locations. The ticket size is going northwards because of inflation, as I said, but your yields, incremental yields in large locations are dropping. I will not say substantially, but they are dropping. To counter that effect, what we are doing is we are going deeper, where you get ticket size which is half of what I do at a regular large location. So I get a 5.5 lakh kind of ticket size from deeper impact locations, and I get 300 bips higher yields. So at the company level, I am able to balance out. On one end you have yields dropping and ticket size increasing. On the other end, you have ticket size dropping and yields increasing. So at the company level, we are still at a 10 lakh kind of ticket size and about 13.8, 13.9 incremental yields. You touched upon the asset quality. We've been in deeper locations. We have about 140 branches up and running, and we don't see any trends of our, the consumers going bad.
Okay. So is there risk from competition? Is that something you're visibly seeing?
Okay, before I come to competition, maybe I can just add a little bit more on the asset quality in the
Please.
deeper impact applications. You know what happens, Harsh, is, and you'll have to relate to what I say, is, and I've always said, and I've met you 3, 4 times, and I've made this statement that the consumers I lend to, the emotional attachment to the asset is very, very high. I think that plays out when we go deeper. It plays out more deeper. This consumer is going to make only one house in his lifetime, so the emotional quotient is very high, and hence, while you would see a little more bounce because it is the banking habits are still to develop in deeper impact locations. But when it eventually comes to consumer becoming NPA and we going surfacey and using legal tools, that's where the consumer gives up and tends to pay up. So that plays a very important role. On competition, the good part is, and while I'm sure the industry is talking about a lot of large players coming into affordable segment, but the way it has transited over the last 6-7 years, Harsh, is within affordable, which is described as loan amount up to 35 lakhs. Within that affordable segment, there are two clear distinctions. One is companies which operate in average ticket size about 15 to 20 lakh, upward of 15 lakhs, about 20 to 22 lakhs. And these are companies like PNB Housing Finance, ICICI Home Finance, the entry of Bajaj or entry of Godrej, etc. And then there are these companies like us who operate in average ticket size below 15 lakhs. As I said, my ticket size happens to be only 10 lakhs. We are not seeing any traction happening on the segment that we operate, which is called as low income housing. So whatever traction is coming in the affordable segment.
Okay. So on your income statement, if I were to just break down your income statement and balance sheet together, your capital adequacy is at 46%. This is likely to come down as you continue to grow. My understanding is you will take on more debt. Please give us a perspective on what the plans for the next 3 years are, because you have enough bandwidth to continue to scale without doing an equity raise. And that will also mean that your ROA shrink because your interest expense will start to creep upwards. Just talk us through what the journey will likely be like.
Great. So first thing first, let me give you a little flavor of our current borrowings. Today, our AUM stands at about 24,000 crores, Hers. And if I were to remove the direct assignment and the co-lending that we've done, which is approximately about 4,000 crores, so my loan book today stands at 20,000 crores. And my borrowing is at 15,000 crores. So my equity utilization is only equity and profit plowback is about 6,000 crores. Maybe I'll give you a little other flavor of looking at car and income level and debt is leverage. Today we operate at a leverage about 3%, and the way we look at Aadhar Housing Finance couple of years down the line, we will look at a maximum leverage of 4%. And I'll give you what is the logic of 4%. Most of the rating agencies become a little uncomfortable the moment the leverage reaches anywhere between 4 to 4.5. And since we are very well capitalized, I think that's the leverage levels we will be in. We will try and maintain it below 4 levels.
Okay, so what does that indicate in terms of runway? When is the next equity raise expected given a 22 to 24% AUM growth clip?
I don't foresee, at least in the near future, 2 to 3 years time frame, any equity raise is required by the company. And we, in discussion with the current promoters, I don't think we are going to be doing that.
Understood. And therefore, how will the added borrowing on your balance sheet impact your ROA is what I'll be very keen to understand.
See, we are currently operating at about 4.4% ROA.
Yes.
The way we look at our business for the next 2 to 3 years, Harsh, is the same range, 4 to 4.3 is the ROA we will be maintaining.
Okay. And so therefore, where will you lever? What lever will you use to maintain that ROA given that interest expense will start to climb, just given the fact that you'll be growing borrowing? There's no other reason there's no cost of borrowing increase per se, but what is that lever there for that you'll use?
The cost of borrowing, Harsh, is obviously the way the markets are today, and you've just seen a cut happening by the central bank. While when we borrow in this 15,000 crores, etc., it comes on either a repo rate or MCLR link. A repo rate, which is about 12% of my total borrowing, gets impacted immediately, and we foresee MCLR benefits also coming in the near future. I think where we are going to leverage is our OPEX reduction with all the technology investments that we've done over a period of time. Efficiencies and productivity levels are going to creep in as we move ahead in the next couple of years.
So therefore, where should your cost?
It's going to be OPEX.
Understood. So where should your cost to income lie, therefore, sir? And what should the journey be? 1 year, 2 years, 3 years? What's the thought?
Cost of income today, we operate, Harsh, at about 36%, and we've always guided that a reduction of a percentage, 100 bips year on year for the next 3 years is what we're looking at. So 3 years down the line, we should be at a cost to income about 33.5%.
Understood. And sir, with regard to promoter holding, will it continue to be at this 75% plus kind of level? Will it come off significantly, or will you see minor dilutions start to come?
I have, and I'm smiling on that question because I have already answered that question on your platform earlier, and I will stick to that. See what the way it is panned out. See, ultimately, it's a private equity investment which has to die down over a period of time. Having said that, the fund from where Blackstone is currently invested, the fund life is till 2030. So we have good 6 years balance in the balance life of the fund. So I don't, and we are not seeing the promoters being in any haste or in any discussion of diluting the current shareholding, which is at about 75%.
Okay, point noted. Sir, last question, and if you can keep your answer maybe less than a minute, because that's what I've been flagged for. What are the risks in your opinion here?
Harsh, we see two types of risks in our business on a BAU daily basis. One is, and both are related to the word attrition. One is book attrition, which is BT out, and one is employee attrition, which was on a rise till about 6 months back, and we see it plateauing out today. So both attritions are the risk to the business. Having said that, we are today at about 6.2% BT out, and the endeavor is to bring it back to about 5.5%, which is a comfortable range.
Okay, thank you so much, Mr. Anand. Always great chatting, candid conversation, and thank you for answering all the questions, including the little tricky ones.
Yeah.
But thanks for coming in and speaking with
Thank you,
us.
Harsh. Have a good day.
Thank
Bye-bye.
you too, sir. Anyway, so that's of course the management of Aadhar Housing. Interesting one. It's a record with regard to the rating as well. But more importantly, the risks are to be well kept in mind. So do look at all of it properly. But with it, we hope that we've covered all the bases. With it, out of time on this edition of KYC. Stay tuned to NDTV Profit. More action on the other side.